G'day expats and welcome to another episode of Expat Chat. We're doing another special episode today where I'm joined with my co-host, Edward Cole, who's one of the partners at Cross-Border Financial Planning USA. Edward was on one of our recent episodes where we talked about US retirement accounts, and I've managed to get him back on the podcast again for another episode where we're going to talk about taxable accounts in the US and just some considerations for those that are listening that are in the US or heading over to the US. Before we jump into it and I get Edward on the line, quick disclaimer, anything you hear today should not be construed as personal financial advice or any form of advice. If you do need advice, please feel free to reach out to either myself or Edward. Anything you hear today is to just be consumed for information and entertainment purposes only. Okay, let's jump into it. Good afternoon, Edward. How are you going?
Yeah, good. Thanks. Yourself?
Oh well, mate. It's a lovely Friday morning on the Gold Coast, and spring has definitely sprung, and we're sort of already having 30-degree days here. So it's been a bit of a rude shock, very quickly compared to winter. I was in Melbourne only a couple of days ago, and I think the temperature was about 8 degrees one day. So it's a stark contrast. And I guess when I think about the weather changes and talking with you today, mate. How's everything on your side? How's work going? How's cross-border financial planning US going?
Yeah, it's going well. We've in the recent move over to the West Coast has meant we're sort of now growing our presence over this side as well as being over on the East Coast.
Yeah.
So that's kind of been that's going well. We only started that this summer, really, the LA office.
Yeah.
And then on a more personal side, we've had some family recently who visited. So we're hosting those, and thankfully they just kind of wanted a bit of downtime to relax after traveling, which always makes hosting a bit easier. So we don't have to
Yeah,
think of too much to do. But
that's
yeah,
right.
it's been good.
That's right. I know personally, we've got some family staying this weekend, which are coming down from Cairns, but we'll be doing the whole hosting thing where we'll be running around doing things. We won't be just chilling out, zenning out. So I get it. I get it. It's always a bit preferred when you don't have to do too much. But mate, we're digressing. I love to digress, and I want to jump into today's topic with you. And I guess just getting a bit of an insight from yourself about, some of the taxable accounts that you can use to invest on the US side and I guess how they are different to the different types of retirement accounts we talked on the previous episode.
Yeah, I'd say two of the main differences really are probably down to the taxation and the flexibility. So if you have a taxable account, you're not going to get tax relief and tax deferred gains like you would with your 401k.
Mm,
But then in exchange, you haven't got the same restrictions. So you can access it at any age. And I guess quite pertinent to some is that you haven't got to worry about contribution caps. So you can put as
yes.
much away as you want. So it's always a bit of a trade-off. If you get more of one, you get less of the other. That tends to be the way. So that's really the two differences. I would say the biggest would be the taxation and the flexibility.
Yeah, and I mean if I compare it to I guess um in Australia, superannuation funds as an example, much like your clients I suppose retirement accounts, we've got our contribution caps. There's less flexibility on when you can access them. Whereas taxable accounts, obviously complete flexibility, can stick to your dollar cost averaging contribution plans, pull out funds, get creative with the investment strategies. So I guess there's a lot more options. And I guess with your kind of clients, what role do you see some of those taxable accounts playing?
So I think as well as the flexibility, a taxable account can actually be a tax diversifier. So if you've already put money into, say, a pre-tax retirement account and a post-tax retirement account, then the taxable account could add a sort of a third option when it comes to tax planning strategy, and that's just because it's taxed differently. So if you're going to go down that route in terms of allocating to different accounts, you want to make sure you're optimizing which assets go in which account. So you might, for example, put more of your corporate bonds in the retirement account, but then your muni bonds and your stocks that you hold longer than 1 year are more likely to be your taxable account. So I suppose just to kind of elaborate on that, muni bonds, depending on where you're resident and which state issued the bond, they're generally free from income tax at state and federal level. And then for your stocks, if you're holding them more than 1 year, you get the more favorable capital gains rates rather than stocks that are held for less than 1 year, where the short-term capital gain is your ordinary income tax rate, and that's typically going to be higher for most people. So those are some of the reasons. I think another reason that people look at taxable accounts actually is your estate planning benefits can come with those. So if you've got quite large gains on shares and you pass them on to your heirs, they're going to get a step up in the cost basis. So, and that's quite a valuable perk, along with the fact they don't have to worry about required minimum distributions on the account. So those are other reasons that people might. Yeah, I suppose it's important to note that if you are a non-resident alien, the tax can be quite severe for owning these accounts, sort of the problems, and that's just because of the allowance. The federal estate tax allowance is reduced to 60,000. So there's a significant reduction before the 40% rate applies. So something to be mindful of.
And what about, I guess, talking about those accounts, what about when you actually eventually leave the US and, and a good example would be for probably our listeners, if you're an Australian and you decide to move back to Australia, what happens in that instance to those taxable accounts?
So if you move back to Australia, it does change things. Thankfully, it is generally for the better. So again, if you've got quite large gains on that account, the cost basis is going to be reset to the value on the day that you return. So essentially what that means is you could build up quite large gains in the account and then sell them free from US or Australian tax and from return. So that can be quite a valuable benefit to those accounts. If you're US citizen and you still have to pay US taxes, then clearly it's not going to work quite the same. And you do have to be aware of other things like the exit tax and things like that, for example.
No, that's good. And I mean, I was talking for our listeners, I was talking to Ed just before this about a few different client situations, how they've only been on an E3 visa in Australia, in the US, and they've been there for a few years and they've come back to Australia and looking to unwind, some of their shares in the US, but we don't want to do it until we've sort of ticked every box, and that might mean sort of notifying that platform that they're a non-resident alien now, Australian address on file, W8 Ben's done, and it just means that when they're selling down those shares, and as Ed put, that the cost base does reset because these guys are on an E3. They don't have continued reporting requirements anymore with the US. They're very lucky they're not a green card or a US citizen. Exit tax isn't a thing for them. So they're actually really lucky where that capital gain on that portfolio, it's actually completely exempt, especially when we decide to unwind it over the coming sort of 6 to 12 months in the right manner. But you touched on an important thing there, exit tax. Can you just give our listeners a bit of a high-level summary of what the hell that is?
Yeah, it's not the most common known tax around, but it's a tax on your unrealized gains and some tax deferred accounts. And this is based on an assumed sale the day before expatriation. And if that deemed gain is more than $821,000 for 2023, then the exit tax can apply.
Yep.
So it's
it's pretty severe. But I mean, what are some of the other things or the minimum sort of criteria to satisfy that exit tax? So I think you've said it before, where you need either be like a citizen or a green card. And what are the different 3 criteria that you need to satisfy? Like what's in terms of like the asset level and those sort of things?
Sure, yeah. So as you say, a US citizen, if they're renouncing, or a green card holder, resident for 8 of the last 15 years, those are the people it's going to affect. But as you mentioned there, the 3 tests, that's what makes you a covered expatriate. So as well as fitting one of those criteria, you've got to become you've deemed a covered expatriate. And there are 3 tests, as you say, for that. So probably the more commonly known one is the net worth test. And that is just having a net worth in excess of $2 million. There are a couple of other tests which I do think are probably less known about, and that is the net income tax liability test. So if your average income average net income tax liability is more than 190,000 averaging over the last 5 years, then that again can also make you a covered expatriate. And then also just not simply keeping up with your tax obligations for the last 5 years. So if you fail to meet one of those, and it's
Mm.
just one of the three, you don't have to meet all three, then you would be deemed a covered expatriate. And
Yeah.
I think when it comes to meeting the net worth test, that can be closer for some people than they may initially think. If you've got a property in somewhere like San Francisco or New York, you can be well on your way towards that 2 million test where, in places like that. So,
Yeah.
if you're maybe 5 years into having a green card, 6 years, and you're deciding whether to come back or not, and that situation is there applying to you, and you maybe are, then it's certainly worth thinking about because, yeah, the tax penalties can be quite severe if you are, it does apply to you.
Yeah. And I think, I mean, when I look at those different tests, like I would say that anyone that sort of has that average $190,000 US sort of tax liability, I mean, they're obviously on a pretty good income in the US. That's a large tax bill that you're paying each year.
Yeah.
Um, so usually, if you're a high income earner in the US, then, that's sort of what you'd be looking at, your tax liability first and foremost. And I agree with you. That net worth test, I don't think it's changed too much in terms of that, like the $2 million threshold for some time, which is a bit strange. And if I sort of look at that test and I look at a lot of my clients, they've got sort of maybe an old main residence back in Australia. Um, they've got
Yeah.
like a super fund. Okay, cool. There's two assets. And if they're from Sydney or Melbourne and they've held that main residence for 10 plus years, it's going to be worth, a really good amount. Um, if they've got super, they might have, 100 or a couple 100,000 in there and then some savings, maybe another property. And then it's like, oh, hang on, what have you got in the US? Oh, okay, you've got maybe some RSUs or just some shares in the US. You've got a property. The test and the assets, it adds up very quickly. And that's probably the one that's actually going to capture, I would say, a lot of expats, to be honest. I agree with you there because your assets just stack up very quickly. With and what's unique about, I suppose, the US having sort of that exit tax is, I guess Australia doesn't really have an exit tax typically. I mean, we have something called deemed disposal, which only applies to, say, direct shares. And then when you are a non-resident of Australia, you do miss out on some concessions, some tax concessions. But that's pretty standard with a lot of countries. Um, but then I guess the question that sometimes I get asked is, why would a US citizen consider renouncing, getting rid of it, and going through maybe a potential exit tax hit? And I guess there's definitely going to be a few benefits. Number one benefit, no longer having to do the ongoing sort of US tax returns, US reporting requirements for the rest of your life. Now, that's a
Yeah.
really big one.
That's quite
And
a nice benefit.
yeah, exactly. That's a massive one. And I guess we've got to remember that the IRS is a bit unique in the way it taxes certain things. And, a good example is US or Australian sort of managed funds and ETFs, PFIX. Someone that's not a US citizen anymore doesn't have to worry about that. You can get a bit more creative with, tax structuring in Australia. If you're not a US citizen, that might involve, say, a family trust or a company. Um, your super fund's no longer taxed by the IRS. You can contribute a lot more. You can get a bit more creative. So there's definitely obvious long-term benefits. Also a case where the IRS doesn't get to tax you on your wealth accumulation going forward anymore. So that's a really important one. And then I know personally with some of my clients, they've got sort of a bit of a blended family isn't the right one, but right term, but one individual has renounced their US citizenship while the other one hasn't. And that just allows us to be a bit more creative in that individual's name that's not connected to the US anymore with tax structuring and wealth planning and growing their assets a bit more strategically. That's usually going to be pretty common where I guess even your clients, Ed, where they might sort of have intentions to maybe do a bit of retirement in the US and a bit of retirement in Australia. So they want to have like some of their US sort of retirement accounts still going, but they also want the ability to have some of those other assets back in Australia, which aren't caught out by the IRS because they're owned in that other individual's name. So that's probably the main one. We're quite lucky with Australia. You briefly touched on sort of estate taxes. We don't really have a wealth tax or an estate tax in Australia yet. Hopefully it never changes. Um, but I know that's sort of what I would consider the main reason that most people might sort of renounce their citizenship just so they're no longer taking that tax hit anymore going forward.
Yeah. Yeah, I think that's definitely a thing that is in consideration when people are trying to weigh up whether they want to, take that hit on the exit tax if they
Yep,
can, and to trade off in terms of, the long-term potential estate tax versus, the Australian situation. So I think that definitely is part of the calculation when people are looking at it.
that's right. And like, even if they're giving up their green card or their US citizenship, and if they've got at least their 10 years in the US or 40 quarters, they're still owed and they can still lodge Social Security. So they're not really
Mm.
giving up those benefits. It's just doing that sort of firm tax hit on their well assets, not going to have to worry about it. Um, I reckon it would make sense for those types who are still quite young, another 15 or 20 years working life. If it's a case where you're pretty much retired, uh, I don't know whether it would be worthwhile, but then you might try and address it now so you're not having to worry about estate taxes down the line for your, I suppose, beneficiaries, your kids, all those sort of things, their kids, grandkids, all those sort of things. So that's probably another reason why you might consider it. Mate, that's been a really good episode today. I really appreciate you jumping on. In the meantime, guys, keep an eye out on the socials and on the different channels. We're going to be looking at doing a webinar at some point in November, and we'll release a bit more information on that shortly. But Ed, really appreciate you coming on today.
No, great. Thanks for having me, James.
Thanks, guys.